Most people assume that wealth is created by stocks, currencies, or whatever happens to be popular at the moment. But history tells a very different story. Empires rise, empires fall, governments change, monetary systems evolve, technologies revolutionize civilization, and yet across 5,000 years of recorded human history, only a handful of assets have maintained purchasing power through wars, inflation, debt crises, currency collapses, and the rise and fall of entire civilizations. Here's what's really fascinating. Thousands of currencies have disappeared. Countless companies have gone bankrupt. Political systems have changed. But three assets have never gone to zero. Not once. From the ancient kingdoms of Mesopotamia and Egypt, through the Roman Empire, the Renaissance, the Industrial Revolution, and into the digital age, these assets have survived every monetary experiment humanity has attempted. And that raises an uncomfortable question. What do people instinctively turn to when confidence in paper wealth begins to weaken? Because we are living through a period unlike anything seen in generations. Government debt has reached historic extremes. Central banks continue to wrestle with inflation. Geopolitical tensions are reshaping global trade. Energy security has become a national priority. Supply chains remain vulnerable, and nations themselves are preparing for a world that may look very different from the one investors became accustomed to over the last 40 years. Most investors are looking in the wrong place. Few people understand the chain reaction that could unfold when confidence, debt, inflation, and geopolitics begin interacting simultaneously. And that's exactly what we're going to explore today. We'll examine why three assets have endured for thousands of years. We'll look at what history teaches us. We'll explore why governments and central banks continue paying attention. We'll examine the relationship between supply and demand, and perhaps most importantly, we'll discuss what ordinary people should understand in an era of growing uncertainty. Because markets change, technologies evolve, but human behavior has remained surprisingly constant. And understanding that may be one of the most valuable forms of wealth preservation available. Along the way, we'll uncover 6 major insights. Why these assets matter. What history reveals. How supply and demand continue shaping value. Why governments and institutions are paying attention. Why monetary risks matter more than many people realize. And what ordinary people can learn from 5,000 years of financial history. Let's begin with what most people don't realize. When we say that an asset has never gone to zero, we're talking about something profoundly different from price fluctuations, because price and value are not always the same thing. Think of the global economy like a machine. Currencies are the lubricant, financial markets are the gears, governments provide regulation and structure, but underneath that machine lies confidence, and confidence itself is fragile. Throughout history, currencies have come and gone. The Roman denarius eventually lost much of its silver content. The French assignats collapsed. Germany experienced hyperinflation in the 1920s. Zimbabwe and Venezuela demonstrated more recently how quickly paper promises can lose credibility. But despite these episodes, 3 stores of value consistently retained purchasing power: gold, silver, and productive land. Here's what most people don't realize. None of these assets generate value because governments decree it. Their value emerges from scarcity, utility, and human trust developed over thousands of years. Gold served as money for empires. Silver facilitated commerce across continents. Land provided food, shelter, and productive capacity. These assets survived because civilization itself depended on them. Mainstream discussions often focus on quarterly earnings, interest rates, or stock market fluctuations. But history suggests that preserving wealth over generations involves thinking differently. It means focusing on what cannot be printed, what cannot be manufactured instantly, and what humanity continuously needs. Let me explain this with a simple analogy. Imagine a ship crossing the ocean. Stocks represent the sails, currencies represent the wind, but these 3 assets are the hull itself. Conditions change, storms arrive, but without the hull, nothing else matters. If you're interested in understanding the forces shaping precious metals and the global economy, consider subscribing. I post videos like this regularly, because once you begin studying history, you realize that wealth preservation isn't about predicting every headline. It's about recognizing the patterns that have survived for thousands of years, and those patterns tell a remarkable story. To understand why these assets have endured for thousands of years, we need to examine something that ultimately determines value in every market: supply. Because scarcity matters. And scarcity is often misunderstood. Most people see a gold coin or a silver bar and assume that because these metals have existed for millennia, there must be plenty of them available. But the reality is very different. Think about it this way. Imagine trying to fill a swimming pool while someone keeps turning off the hose. That's essentially what the mining industry faces today. Discoveries are becoming rarer, ore grades are declining, permitting timelines are becoming longer, and energy costs continue to rise. Mining is one of the most energy-intensive industries on Earth. Diesel fuel powers giant trucks. Electricity drives processing facilities. Explosives, chemicals, transportation, labor, and regulations all add layers of complexity. Meanwhile, many of the world's largest producers face geopolitical uncertainty. Mexico remains one of the leading silver-producing nations, yet political changes and regulatory concerns have created uncertainty for future investment. Peru, another major producer, has experienced repeated social unrest and disruptions around mining projects. China dominates large portions of the refining and processing chain, creating strategic concerns for Western economies. Russia continues to influence global commodity markets through sanctions and geopolitical tensions. Chile, essential for copper production and increasingly important for the energy transition, faces water shortages and environmental challenges. Australia remains one of the world's most stable mining jurisdictions, but even there, rising costs have affected profitability across the industry. Here's what many investors overlook. New mines take years, sometimes decades, to develop. You can't simply decide to produce millions of additional ounces tomorrow. Nature doesn't work that way, capital doesn't work that way, and geology certainly doesn't work that way. Gold and silver are finite. Productive farmland is finite. High-quality agricultural land, especially land with access to water and infrastructure, becomes increasingly valuable as populations grow and urbanization expands. Human civilization can innovate around many constraints, but it cannot create more elements from nothing, and it cannot manufacture fertile soil overnight. History shows that scarcity combined with utility creates enduring value, which brings us to an equally important question. Supply is only half of the equation. Demand is where things become truly fascinating, because the world of the 21st century is creating entirely new reasons for precious metals and productive land to remain relevant. Gold has always been associated with money and reserves, but silver occupies a unique position. It is both a monetary metal and an industrial metal. That distinction matters, because modern civilization increasingly depends on silver in ways that few people appreciate. Every solar panel contains silver. Electric vehicles require significantly more silver than conventional cars. Consumer electronics rely on silver because of its unmatched conductivity. Artificial intelligence infrastructure, data centers, semiconductors, and advanced electronics all depend upon highly conductive materials. Defense systems, satellites, radar technologies, communications equipment, and aerospace applications require specialized metals that cannot easily be substituted. And while industrial demand evolves, human behavior remains remarkably constant. During periods of uncertainty, investors continue seeking assets that have maintained purchasing power over generations. Central banks themselves have become major buyers of gold. Families concerned about inflation often turn toward tangible assets. Farmers understand the value of productive land. Businesses understand the importance of real resources. Because unlike financial assets, tangible assets possess utility independent of confidence. A stock certificate requires a functioning market. A currency requires trust. But farmland produces food. Silver enables technology. Gold serves as monetary insurance. And that combination of utility and scarcity explains why these assets have survived every major economic transformation humanity has experienced. If this analysis is helping you connect the dots, subscribe and join our growing community here at Precious Metals Alert. Because the story doesn't end with supply and demand. History itself provides some remarkable lessons, and history rarely repeats perfectly, but it often rhymes. History rarely repeats perfectly, but it often rhymes. And perhaps that is one of the greatest lessons investors can learn, because every generation believes its challenges are unique. Yet when we step back and examine history through a wider lens, certain patterns emerge again and again. During the 1970s, inflation shocked the developed world. Energy crises, geopolitical instability, and monetary uncertainty combined to create a decade that changed how people thought about money. The purchasing power of currencies declined, confidence weakened, and investors increasingly sought hard assets. Gold and silver responded accordingly, not because they were magical, but because uncertainty itself altered human behavior. Then came the financial crisis of 2008. Banks once considered untouchable suddenly found themselves under extraordinary pressure. Liquidity evaporated. Credit markets froze. Central banks responded with unprecedented interventions. Interest rates approached zero. Quantitative easing became the new normal. Once again, trust in financial institutions was tested, and once again, tangible assets regained attention. Fast forward to 2020. COVID disrupted supply chains across the globe. Factories shut down. Shipping routes became congested. Energy markets experienced historic volatility. Entire industries discovered how interconnected the world had become. Shortages appeared in products many people had previously taken for granted: semiconductors, medical equipment, food products, industrial metals, and perhaps most importantly, confidence in just-in-time supply chains began to change. Even the silver market experienced unusual stress. Retail demand surged, premiums expanded. Physical supply became increasingly difficult to obtain in some areas. The so-called silver squeeze reminded investors that paper markets and physical markets do not always behave identically during periods of stress. Energy shocks throughout history tell similar stories. Whether in the 1970s, after geopolitical conflicts, or following unexpected disruptions, rising energy prices have consistently influenced inflation, production costs, and economic confidence. Because energy is embedded in everything: food, transportation, manufacturing, mining, housing, modern civilization itself. And every time uncertainty rises, people instinctively begin asking the same questions. How do I preserve purchasing power? How do I protect savings? How do I navigate an uncertain future? History offers no guarantees, but it does offer perspective. And perspective is often more valuable than predictions, because understanding patterns helps people prepare rather than panic. Which brings us to something particularly interesting. The people and institutions managing enormous pools of capital are paying very close attention to these patterns, and that should make all of us curious, because smart money often studies history before making decisions. Not headlines, not emotions, history. Over the past several years, central banks around the world have accumulated gold at rates not seen in decades. Why? Because nations themselves recognize that monetary systems evolve. The World Gold Council has reported record levels of official sector gold purchases. Emerging economies are diversifying reserves. BRICS nations continue discussing alternatives that reduce reliance on the US dollar. Meanwhile, government debt levels continue climbing across developed economies. Budget deficits remain elevated, and interest expenses are becoming increasingly significant. The International Monetary Fund, the World Bank, and numerous economists have repeatedly highlighted concerns surrounding long-term debt sustainability. No one knows exactly how these challenges will ultimately be resolved, but history provides clues. Governments facing excessive debt often choose between difficult options: higher taxes, financial repression, inflation, currency debasement, or some combination of all four. And that reality explains why family offices, institutional investors, and sovereign entities increasingly emphasize diversification, not because they expect catastrophe, but because they understand uncertainty. Because preserving wealth is not about making one giant bet. It is about managing risk. Central banks themselves continue holding thousands of tons of gold, and perhaps that's worth reflecting upon. If fiat currencies alone were sufficient stores of value, why would nations still maintain precious metal reserves? Why do countries continue repatriating gold? Why are emerging economies steadily increasing allocations? Perhaps because history teaches that confidence is valuable, but confidence can change, and prudent preparation has always mattered. If you're finding value in these deeper macro insights, consider subscribing because we cover the stories mainstream media often overlooks. Because understanding what institutions are doing may reveal far more than listening to what headlines are saying. And ultimately, all of this raises the most important question of all. What does any of this mean for ordinary people? Because wealth preservation isn't just a concern for governments and billionaires. It affects everyone,